Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Duke Ong with Tri-City Equity Group. For this episode in our educational series, we'll be talking about why multifamily from a limited partner perspective. With me is my co-host, Vince Giffings.
Hey, Duke.
Hey.
So this call here, this education series, we're going to be going over why multifamily. So we're going to cover the top 10 reasons of multifamily versus other asset classes that you might be interested in. So Duke, why don't we go off with the first one, which is the resilience in tough times.
So as of this writing, multifamily has been resilient throughout the COVID-19 pandemic of 2020. According to the National Multifamily Housing Council, apartment owners across the U.S. saw rent collection at roughly 80% through May 6th. This is up from this time in April of 78%. Compared to this time last year, it was 81.7%, so it's only lower by 1.5%. So it really shows that it's only a slight decrease due to the coronavirus pandemic. So generally, multifamily is better protected against economic cycles, particularly because the need for shelter is an essential need. And that has been shown even more evident in uncertainty times. So in general, it's an evergreen business model. Looking back at the 20 worst quarters over the recent past for a portfolio consisting of, say, 60% stocks and 40% bonds, out of those 20 quarters, real estate was up for 17 out of those. So it really shows the resilience and strength over the long term. So next is the hedge against inflation and stock market volatility.
Yeah, and that kind of goes right into what you were just saying about the different economic cycles and housing being an essential need. That goes a lot into the volatility of it. Is multifamily commercial real estate has been historically less volatile than other sectors, other industries, especially in commercial as well. And it's because it's not really correlated. When you're looking at other commercial type assets, say you're looking at retail, office buildings, stuff like that, the forces that are driving the performance on those are going to be different than the forces that are driving multifamily housing. We follow a lot more of just population growth, job growth, and the fundamentals of an MSA, where other commercial vehicles are going to be a lot more susceptible to market volatility for whatever industry that they are part of. For example, retail right now, retail and restaurants, we're talking right now, May 20th, middle of coronavirus, retail is getting slammed right now because a lot of the doors are shut right now and they're just not able to operate, where we are, in the 80s for collection, 80% collection this month. And during some of the worst times we've had in recent history. So that is one thing, is just market volatility. And another thing is that with real estate being a hard asset, as the dollar continues to deflate over this 100-year trend that it's going on, where each year it's worth less, hard assets will appreciate, or it will gain from inflation because of that. So it's a hedge against inflation because it's a real asset that's going to increase in value as the dollar decreases. Where if you have things like savings accounts or something like that, where if it's anything in cash, it's going to be highly susceptible to inflation or depreciation of that dollar. So that is one of the good reasons I like multifamily. Just it's a hard asset, and it has different driving forces of it that make it a lot less susceptible to volatility across the industry. So next one is going into the superior tax benefits of multifamily. So Duke?
So multifamily is an amazing tax shelter for multiple reasons. Some of these include deduction of expenses such as mortgage interest against income, depreciation, tax-free refinances, 1031 exchanges, and wealth transfers to heirs with a stepped-up basis. So we don't have time to go into every single one, but the recent tax reform now allows investors to take depreciation, which are paper losses, to offset passive income gains from these investments. And if you couple that with cost segregation studies, which are accelerated depreciation and bonus depreciation, apartments continue to be one of the best vehicles for optimizing net income. So remember, it's not just about how much you make, but it's how much you keep. All right, and next one is undersupply of housing.
Yeah, absolutely. And this is something that is going to be a trend that's going to continue, is that the population is increasing in this country, and it's increasing faster than the deliverables being brought to market, the product being brought to market. According to a recent CBRE study, is 160,000 units short is the undersupply every year for units that need to be brought online. So 160,000 units short every year across the country. And so what that's going to do is, one, it's going to cause single-family houses to increase further. So it makes young families or people that have median household income maybe below 60,000. It's going to make that barrier to entry to buy a single-family residence that much harder because they need to come up with a lot more. They just might not have the purchasing power. Also, the combination of tighter, more conservative lending requirements from banks. We're seeing more reserves, higher credit scores, things like that. So just a lot of people are just not being able to qualify for single-family houses. And that's one driving force. The other one is, as a nation, we're moving away from the home ownership. The American dream of owning the white picket fence and the 3-2 house with 2 kids and a dog. That vision. We're moving away from that. We're becoming much more of a renter nation, where young professionals want to be almost nomadic. They want to move a place, move to a city, work there for 3 or 4 years, get that experience of that city, and move to another area and have that flexibility, not be tied down to one location with a mortgage as a ball and chain that they need to have this thing looming over their head. They want that flexibility and that freedom to move around as they see fit. And that's one side with the millennials, which is now the biggest population segment in our country is that millennial generation who's driving some of this force. And then on the other end is the baby boomers. 10,000 baby boomers a day reach retirement age, and as they hit this 65 year age where they're going to start being eligible for retirement, a lot of them are going to want to start downsizing their life requirements. They're the empty nester, so to speak. So the kids are gone. They don't need this giant house anymore. They can downsize their house, move into an apartment. They don't have to take care of the house. They don't have to do lawn care. They don't have to wrench on normal house maintenance things. They just want to move into a nice, clean apartment community. Safe, has some amenities nearby, and just enjoy retirement and not have to worry about maintaining a home anymore. So on both ends of the population spectrum, multifamily is coming out on top, and we see that in the numbers. The growth of rents, is outpacing a lot of other metrics in this country. So all the metrics that we see are leading toward multifamily is the place to be over the foreseeable future. So next question is the flight to safety, Duke.
So global investors are seeking safety in assets like U.S. multifamily as they consider the risks of other paper assets. So the reason for this is it provides for better yield and stability. So one key part of the yield component is the current income in the form of cash flow from day one, which is defined to be the income left over after deducting operating expenses and debt service from the collective rent. So yield comes from the net distributable income after expenses. So yields available in other asset classes, such as dividend-paying stocks and bonds, tend to be a lot lower than those of multifamily real estate. So next is control.
One of my favorite ones, and this is one of the reasons that drove me to multifamily or just real estate in general, because I used to do, if anybody knows my backstory, if you listen to that show yet, I was big into stock trading. I did a lot of ETFs, a lot of individual stock companies. I did swing trading. I did all that. I was fully engrossed in Wall Street and stock trading until the point I got burned. And I got burned because I know we're getting off on a tangent real quick, but I did about 6 months of research into this company. Everything checked out good. I ran all the numbers. Everything looked good. The future was bright for this company. And then all of a sudden, news broke that the CEO and the CFO were submitting falsified documents to the SEC and the shareholders. The company went from around $35 a share down to 30 cents a share. It's pretty much in a straight shot and a nosedive over the point of about 10 days as everybody was trying to figure out what's going on. Is this real? Is this fake news? Like what's going on? And it turned out it was real. And this happened, and the stock wasn't worth. The company was, severely in debt, couldn't pay its debt service, and imploded on itself. And this is one of the industry leaders in this sector I was investing in. At that point, that was the straw that broke the camel's back for me. Was I just wasted 6 to 8 months looking into this company just to find out that at the end of the day I had zero control. I thought I was doing the right things. I thought I read all the books, ran all my own numbers and my own pro formas, so to speak, my own financial models. Everything looked good. The sector, the industry that this company was leading in looked good, but you can't control what the board does. You can't control what the CEO does, CEO, CFO, any of those people, you can't control them. And that's what I needed. I needed control of my destiny in my life, and multifamily or real estate got me that. So now I can choose who my property manager is. I can choose who my residents are. I can choose who my partners are. I can be the one that makes all the decisions. Like in this company, I'm the COO, so I can make all those day-to-day decisions of what contractors we're using, what vendors we're using, all the things that control my property, who my residents are. For the most part, I can control that within legal fair housing laws. But I have the control over that asset and steering that ship. And that was a big one of the biggest driving forces for me to go into real estate, and then more specifically multifamily, was having that control asset, that control of that asset. So the next one is leverage. Duke?
So this is one of my favorite ones. So multifamily allows the passive investor the opportunity of leveraging the sponsor's skills, experience, and network so that they can get into higher quality investments that normally would not be available to an individual investor. Moreover, the project can use leverage from banks or agency lenders to further amplify returns as opposed to just buying it cash. This has an added benefit of asset protection, both for the project level and the LPs, since the lender assumes the majority of the risk in most cases. For example, like a 70% LTV loan means that the lender is taking 70% of the risk, while the project level is only taking 30%. So that's another great reason that multifamily is superior. All right, so next one is scalability as an LP.
And this goes right into the leverage, right? So you're leveraging from the LPs, the limited partner standpoint, you're leveraging the experience and the 10,000 hours, so to speak, that the sponsorship team has already invested over the last 10 years to get to where they are. That you're leveraging that, and you don't have to walk in their shoes for 10 years to get to the same point to play on the same field that they do as an LP. So going into scalability from that, because you're able to leverage so much of not just the money side of it, of getting the debt service, but also the time and experience side of it, of the sponsorship team, you're able to scale much, much faster than you would if you were trying to do this on your own. And that's the other reason I love multifamily versus any other asset class. And I was talking a minute ago about going from stocks to real estate. And then once I started thinking about scaling to the future, if I want to really reach my goals, my freedom number that I had for my family, I needed to scale. And multifamily is when I really niched into multifamily and got rid of the smaller residential properties, the duplexes, the fourplexes, because that's what I started in. Was those were just a lot harder to scale. It would take a lot longer, and it was a lot harder. And with the large multifamily, you can scale so much faster. And from the LP's perspective, since you're leveraging all that time and energy of the sponsorship team, you can go into as many deals as you want as fast as you can get the buy-in, that minimum buy-in for that sponsorship team. If they have, and most of them are around $50,000. So from what I've seen, so if you have 50,000, as soon as you can come up with $50,000, buy-in to put your money into a deal, you can keep buying into deals. You can do 4 or 5 a year. Where if you were trying to do this on your own, you might be able to do 1 a year. If you're really good, you might be able to do two properties a year. This is small multifamily. But if you're able to scale now, you can go maybe buy into 3, 4, 5 multifamily properties, big projects, apartment complexes in 1 year or a short amount of time. That's really going to accelerate. When we're talking about the hockey stick curve of scaling and growth, you're really going to start accelerating up that curve as these projects start turning over. And for me, that's the other thing. So the control, the leverage, and the scalability are the top 3 for me when it comes to multifamily. So the next one is the principal paydown. Duke?
All right, so this one is not as sexy as some of the other ones, but it is one of the safest tools out there to create wealth because it's almost automatic. So assuming that it's a leveraged asset, the rent that residents pay, some of that goes towards paying down the principal of the mortgage. So that means over time, the equity position of the project increases, and this is almost independent of market conditions. So, even in uncertain times like now, the principal is still getting paid down, assuming you're making your mortgage payments on time, and it's a leveraged asset. So it is one of the best benefits of a leveraged asset. So next one is appreciation.
Yep, appreciate. I do have to circle back though for scalability. I forgot to mention another thing on scalability, not just the time and the energy, and then the money part of it. It's also the multifamily is extremely efficient compared to other vehicles. The bigger you get on multifamily, that the cheaper and more efficient on all aspects of running a business is better. The further you scale into a property. And that was a huge light bulb that hit for me. Was I had some duplexes and fourplexes, and then I scaled up to a 6 unit, and then I scaled up to a 52 unit, and then this latest 48 unit. And at one point in the last year, it hit me that I was like, I've been on the phone with my property manager or vendors and contractors on these small duplexes and fourplexes, way more than I've been on the phone worrying about this 52 unit property. And when you think about the economies of scale, like the bigger property has so much more economies of scale to make it more efficient than the smaller properties do. Everything, you can hire bigger firms, you can hire better quality management teams, better quality contractors to run it. You can afford more robust operating systems than you would on the small properties. The small properties, you end up finding yourself that, and for me, I was building myself a job and not really a portfolio, not really a business. With the bigger properties, you can actually afford to buy the systems, the software, the hardware, the pay higher quality people to really build a business, a really efficient business. So that's the other part I want to circle back for scalability. Now, going back to what you mentioned, appreciation. So appreciation is the best part about large multifamily. So the difference between commercial multifamily and residential multifamily is anything under 5 units, so 1 to 4 units is considered a residential property. Residential properties are valued based off of the comparable value approach, meaning if you have a 4 unit and it might be doing great and you go to sell it, they're going to look at comps in your neighborhood and they're going to say your property is worth X amount because the 4 unit down the street sold for, that same amount. So that's what your 4 units worth. And the same thing for duplexes and single family houses. And when you're trying to force appreciation, and this is a lesson learned for me early on in my career, was it doesn't matter what you really do to that property, you're only going to bring it up to the market when you're talking residential. So you can go buy a 4 unit property, do all this stuff, or a duplex, do all this stuff to it, raise rents and all this stuff, but it's only ever going to be worth what the comps are worth in that neighborhood. And that's where I got burned. I bought a 4 unit for $170,000. I put $50,000 into it. 2 years later, I went to go refi some funds out, and it was worth $170,000. And I was like, this is impossible. I raised rents $200 a door. I made the property look so much nicer, did all the things. And they're like, yeah, we understand that. And I've seen the receipts and I believe you, but no other 4 units have sold in this neighborhood in the last 5 years except for yours. So we have nothing to go off. There's no market data to tell us what your property is worth. And based off comp value, it's worth $170,000. Sorry. So I lost on paper $50,000. And the only way to really recapture that is either hold it for a long time to where the cash flow can kind of soften that blow, or sell it and take out the appraisal contingency on sale. So that was the last straw for me with the small properties, the duplexes and the fourplexes. And I was like, I'm never going to buy a residential property again because I just got burned really bad. And there's really, again, back to control. I need to control my destiny, my asset. And there's a degree of influence on your properties that you can't control, which is comp value. Going into commercial property, so 5 units and greater, they're going to do what's called the income value approach. So your property is going to be worth a multiple of the income that it earns. And that equation is normally NOI, net operating income, divided by the capitalization rate for that neighborhood. So you have the control now. You increase, you take a property, you increase rents, you decrease expenses, you increase the overall net operating income, the NOI for that property, and the property will be worth more, proportionately more because of the work and the sweat equity you put into that property. And you multiply divided by the cap rate, and your property is going to appreciate. You can force the appreciation through your operations, through your systems, the decisions you make. You have control of that asset, and that's just something you're not going to get in residential. Those 1 through 4 units. You can get it a little bit if you get like a really good deal and bring it up, but you're only going to bring it up to market value. The properties are sold in that neighborhood, where commercial property is going to be the driving force is NOI. That's the name of the game. You increase the NOI, you increase the value of that property exponentially. All right. So is that it?
Yeah. So let's just recap the 10 reasons again. So they are resilience in tough times, hedge against inflation and stock market volatility, superior tax benefits, undersupply of housing, flight to safety, control, leverage, scalability as an LP, principal paydown, and appreciation. So if you're interested in connecting with us, go to tricityequity.com to learn more. To connect with like-minded investors, join our Facebook group, Honolulu Multifamily and More. And if you found value in this podcast, please subscribe and give us a rating and review on Apple Podcasts or Stitcher. If you know anyone who might resonate with today's podcast, please share the episode with them. See you next time.
All right. See you, Duke.